Welcome everyone to another episode. Our title is Mortgage Rate Crash in 2024. This is Seewing Yee and my special co-host is Mr. Richard at Advani from Guarantee Rate Mortgage. Welcome, Richard. How are you?
Doing amazing. How about yourself?
Yes, absolutely. Absolutely. Thank you for taking time out of your day to go over this very important. A lot of things happening. So without further ado, let me share my screen and let's get the show on the road. All right. So here's the headline: 2024 mortgage rate crash. What does it mean for real estate investors? So let me do a quick recap at the beginning. Then toward the end, we can do a quick recap as well before we conclude on this short Zoom webinar. All right. So my thoughts are, real estate investors out there, you know who you are. Buy now, because right now you're getting more deals, you're getting more incentives and less competition. And we all know every year the spring buying season has always ramped up during February and March timeframe every single year when there are a lot of activities. However, we're not talking about a typical real estate market these days. The spring 2024 buying season, guess what? It has already started, and today is only in December. Therefore, buyers are coming off the sidelines. Once that happens in the spring season, buying season, you will see more competition. The floodgate will break, the dam will break, and prices will go up. Because why? Because people been waiting for the past 18 months. People are itchy to achieve the American dream. People been staying on the sidelines waiting for whatever. There's a lot of shadow inventory frenzy out there. And with that said, still, we believe, you and I still believe there are limited inventory will still persist. At the end of the day, it's all about economics 101. Demand greater than supply equal higher home prices. All right. Now, here's a case example. I just spoke with one of my very good friend, a local realtor here in San Francisco Bay Area, in Fremont to be exact. My old neck of the wood, Fremont, California, in the East Bay. A few days ago, he has listed this home, cookie cutter home, for $999,900 in this location. 3-bedroom, 2-bath, 1,200 square foot. And Tony Bruno said that this home is not even turnkey. This home have not even been rehabbed. There's a lot of unfinished things in the interior of the house. I know you couldn't see it, or nothing to brag about. And this neighborhood is a moderate neighborhood. It's not even the best location in Fremont. Okay. And then let me share with you the thread. Again, this home, like 1,220 square foot, 3-bedroom, 2-bath, is built in 1961. It's a very old house. Okay. Nothing. Anyway, here's the email text thread that we have done a couple of days ago. He asked me by text, what is the sales? Yeah, he asked me to guess the sales price. My guess was 1.1 million. No, he said the highest offer is 1.45 million, all cash offer. Furthermore, there are total within the first week of listing, less than first week, the first few days of being listed, this house has 42 offers. The range are anywhere from $800K to 1.45 million. Out of the 42 offers, 19 were cash offers. Okay. So go figure. Obviously, the housing crash has been grossly exaggerated. With that said, before I will go through the remaining few slides, go ahead, Richard. A lot of things. Oh, by the way, before we begin, the additional headlines are The mortgage rate has decreased substantially this past week, like 0.50 basis point, which is half a percentage. The mortgage rate were as high as 8% a couple of months ago, and now it's like 6.62% per the mortgage news daily. And the inflation is coming down, and the 10-year treasury is getting better in relationship to the mortgage rate. The margin is getting squeezed, which is good. And the Federal Reserve, you know this better than me. The Federal Reserve are not expect to initiate any more rate hike going forward in the next first and second quarter of 2020. Well, clearly, this is not a clear signal of an upcoming housing buying frenzy. I don't know what is. You and I, we do this full time. This is trending very positively. The trends and the signals are all there to see some resemblance of a housing frenzy moving forward. So give me your thoughts. I know you have a lot of thoughts. This is what you do. You are an investment loan agent for many years. You have consulted many investors. So from a high level, so what is your takeaway from the things that I've just discussed?
Yeah. So firstly, exciting times. Interest rates are off of their highs by pretty much over 1% in the last 30 days. And as you can imagine, at 8%, there's huge reduction in volume in demand. However, what's interesting is the housing crash that we all talk about. I think nationally, maybe in some markets, house prices went down a couple percent. So obviously we're far from a crash, but we made it through the worst of it, right? Interest rates the pace at which interest rates increased was the fastest pace ever, right? We've never had the prime rate go up as sharp as it did in such a short period of time. And we've never had mortgage rates also go up in such a short period of time. But as you mentioned too, given that we're 1% off of the highs, the Feds are definitely not talking about interest rate increases. They're done with that. They've made that clear. In fact, they are talking about obviously cuts moving forward, probably to the latter half of next year. But the Treasury bonds have already responded, right? And the 10-year Treasury is down along with mortgage rates. And what's interesting now is that the media and everything now is jumping. They're done with their clickbait, mortgage crash and house prices tumble nonsense. Honestly, it was BS, as Seewing and I have been saying for the last year and a half. As the papers were like, crash, doom, gloom, we were like, I don't think so. It's supply and demand. And the only thing that's changed is the external factor of the Fed's increasing rates. As rates come down, what's going to happen, right? We're back to where we were. There's 20 buyers, or the example you provided, there's 42 buyers for every single home. And interesting statistic is for every 1% drop in interest rate, there's 5 million new home buyers that are now ready to start buying, right? And we dropped over 1% in the last 30 days. Ready, that means there's 5 million more home buyers in the market trying to buy right now than there was even a month and a half ago, right? And as rates continue to drop, that's going to continue. And keep in mind, things are as busy as they are right now in historically the worst time of the year, right? Everyone's on vacation mode. Everyone's in Christmas mode and New Year's mode. Not much activity happens, but the effect of the lower rates is already being seen because there's already multiple offer situations. I think as we move into the latter part of January, we're going to see a huge uptick, especially if rates continue to move down a little more. Investor cash flow is there now at these rates versus at 8%. And demand is going to continue picking up. Look, at the end of the day, real estate, as we've said, is robust and it remains a buy for the right reason, for the right fundamentals. And I think next year is really going to prove more and more what we said over the last year and a half. And I think next year we should actually do a segment where we cite some clips from a year ago, what we were talking about, which was quite the opposite of what the general narrative was out there. And you and I were like, nah, we don't believe it. And boots on the ground says that's wrong. And things aren't as bad as the media is making it seem to be, or they're not heading in that direction either. So it'd be cool to actually, I think, bring some of those clips in, right? So it could be, I told you so. But yeah, I'm excited for next year. I think it's going to be a huge year for real estate investors. It's going to be a huge year for home acquisition. The last thing I'll say is there's a lot of conversation and discussion out there about, oh, hedge funds are buying up and it's becoming a renter's nation, yada, yada, yada. And firstly, I say for a moment, get away from that noise. That doesn't take away from the fact that there's not enough roofs over heads. Okay. There's not enough homes, regardless of whether BlackRock's buying it or I'm buying it or primary home buyers buying it, right? Regardless of who's buying it, there's not enough roof per head. So don't get stuck into this huge thing about it. Yeah, hedge funds are buying it. Guess what? They're smarter than all of us. And they've been buying single family homes for a decade now, as everyone else has been sitting on the sidelines waiting for this big crash to happen. Guess what? The smarter guys have been scooping up properties left and center, and they're going to continue doing it. And yeah, we are probably headed to where we are going to be a renter's nation more than other countries. The question is, what side of the divide do you want to fall on? Do you want to be one of the landlords of this country, or do you want to be a renter? And that timeline, I think, is getting smaller and smaller because number one, there's not enough homes. Number two is, as primary home buyers sit on the sidelines and fear, the rest of us are capitalizing, buying more. Real estate has nowhere to go but up. Don't take my word for it. Look at statistics and look at history, right? And also look at common sense, supply and demand, right? The number of land, the number of homes are finite. The number of people are infinite, right? Populations are going up. People are living longer. Housing will always prove to be, I think, a good long-term bet.
Well, Richard, you pretty much summarized it. And the only thing I need to say is that as we are entering the 2024, all the investors out there, the members that you and I work with, Richard, we need to put your financial ducks in order, put your financial house in order, create a plan, create a written plan, take action on your plan, and take action because the investors this past year, 2023, the investors you work with who have purchased in good markets that we've been promoting, we all done well. The whole prices in past 2023, my markets in Buffalo, Niagara Falls, in Alabama, in Texas, and in Florida, we have done well. Investors, the few investors that bought in 2023 didn't have done well. Everything have met their expectation. The houses did not go down. In many markets, our houses have gone up slightly. The rent has gone up. Vacancy is very low. And our investors have taken advantage of all these great incentives that the turnkey providers have provided, as well as you. Those are the rate buy down, all those great incentives for have stayed in the line for whatever fearful that you and I have been gone over and over again. And make 2024 a great year for you guys out there, investors out there alike. With that said, that's all I have to say. And Richard, thank you so much. We'll come back for the beginning of the year to do a big blowout webinar and just look forward to some great opportunity moving forward and help our investors to achieve the financial goals. Thank you so much, Richard, for your help and assistance and helping me with some great educational contents for the longest time. And thank you so much. And thanks for being. And I'll see you on the next video. Have a nice day. Bye.